marching, it's often achieved by those who labor long and hard. Today, we have amongst us an expert from the trading industry who managed to make it big through indomitable dedication, commitment, and hard work. His desire to see the bigger picture enabled him to achieve extremely prodigious growth and productivity. He developed his own trading algorithms, ex-vice president of Lloyd and Stephens, and a person who managed a portfolio of worth rupees $500 million. Ladies and gentlemen, it's a privilege to welcome amongst all of you Mr. Ron K. Vadhavan. Please give a big round of applause.
Thank you, Jasmeet. I appreciate the introduction. Good afternoon and welcome. I want to thank all of you. I see a lot of faces here from the morning batch and from the evening batch. And to be here on a weekend is definitely a privilege for me. I thank you for that. We are going to talk about an important topic. A topic which is important to all of us, and we don't really talk about it much. You give a man a fish, you feed him for a day. You teach him how to fish, and you feed him for life. We are going to learn today how to feed ourselves for life by learning how to fish in the stock market in a profitable and in a risk-managed way. We are all the time looking for things that will make our life easier. We are going to spend the next 40 minutes, and in this period, I'll be covering a lot of material. So I would like to request you to keep your phones on silent mode and keep your questions to a minute. Now, before I start, I think I had distributed the glossary on the internet, but do you have a copy of that? All of you have a copy?
No.
Where in the WhatsApp? I'm so glad that I made some copies.
एक तो volunteer करो जाओ
Some of that
no बेटा बैठ जा तू नीचे तक काट गया
So I'm passing out the glossary, which I want you to have handy while we do the exercise. Before I start, I have to make a standard disclaimer because we will be talking about financial matters, and this is definitely not a recommendation or a solicitation of any kind. There is a certain amount of risk involved in any kind of trading activity. And I would like to urge you to consult a registered investment advisor before you engage in any such activity that involves risk. So here is the standard disclaimer if you want to take a picture of it and show it to your investment advisor. Very better. I have experienced that in order to achieve anything of significance in life, you have to know the why. You have to know why you want something so badly that you are willing to do anything for it. I don't know what your why is for trading, but I will share with you what my why has been for trading. I come from a very humble background. I left this country about, I think in the mid-80s, and only with $25 in my pocket and an admission ticket. I fell into trading by accident through my professor. And it was a kind of a love at first sight for me. So I started to paper trade because at that time I had no money and I was able to hone my skills. After graduating from Columbia, I was able to land a job on the Wall Street, and I started as a systems analyst, and then slowly I went up to the portfolio management role. For me, the big why was that I had left this country to prove to myself that I can do something beyond the borders of India. And I was in a position that I wanted to make sure that I am able to do what I want to do without any kind of help from my parents. I think there was another important factor, that I wanted to have a lifestyle that was time independent, it was location independent, and it was not dependent upon the economy. I hate to work for people. I'm a very independent person. I like to travel. I have a sense of adventure. So I wanted to have a lifestyle that would allow me for all these things. And trading is what has allowed me to do all these things. So I have been able to maintain that lifestyle. And if you want to have the big why, like I said, for me the big why was bigger than myself. It has to be bigger than yourself. It has to be something that comes from the heart. If you have your big why, you will know how to do it. And the more crystal clear your big why is, you will be able to implement it a lot better. So for me, it was also to spend more time with my family, to do the things I love, to travel. So I'll leave you with that thought that before you get into trading, you shouldn't just do it for money. You can make money in any of the ways in the world that you can. You have to know your big why. The big why you want to do it, and for a purpose that is bigger than yourself. It should be in line with your values, your beliefs, and your passion. These things have to be aligned before you do any activity, including trading. So that was my big why. So you can use that as a template to develop yours. The financially independent life that trading has provided me has allowed me to travel the world many times over. This was the pictures from the cruise that I took in the Caribbean, one of the cruises. And this is the picture of my bedroom, the Pinta's suite. That was the main living room. This is the dining area, this is the foyer. This is me in the casino. And this is me doing paragliding somewhere. So if you want to have that kind of lifestyle, you should be willing to take the risk in a managed way. You should be able to, you have to take the risk in order for you to do what you want to do, but you have to be out there taking the risk. Let's get into the markets right now. So let's first of all talk about the market psychology. Actually, the market is one big psychological marketplace. You have the bulls and the bears. These are the two kind of players that play the market. The bulls think that the market is going up, and the bears think the market is going down. Now these emotions are, or say these kind of feelings that the bulls and bears have the roots in fear and greed. Let me give you an example. Let's say you buy 100 shares of Reliance, say 1,000 rupees. So your total cost outlay is 100,000 rupees or 1 lakh rupees. So your main risk there is 100,000. That's the maximum you can lose. Now say the price of the share goes from 1,000 to 1,100. You made 100 rupees per share, which is what percentage? 10%. Now, that's when the greed kicks in. You think the market is going higher. And instead of going higher, the market goes down. It will take a nosedive. And before you know, that 100 rupee share has become, so that 1,000 rupee share has become a 900 rupee share. So what's your loss there? Minus 10%. So that's when the fear will kick in. So these emotions of fear and greed have to be mastered before you can have any success in the market. You have to know what your profit target is. You have to know what your stop loss is. And that's where people fail. And I'm talking about portfolio managers who are managing multi-million-dollar portfolios. They make and lose money. I mean, they usually lose money because of this indiscipline. So you have to be very crystal clear about your profit target and your stop loss. And if you can master that, you are in the top 10% of the people who are trading the markets. Market analysis. Fundamental analysis is, I think it can be best described by saying that you look to the Main Street to invest on the Wall Street. And that's a very old saying. What it really means is that look at the products and services that you use of the different companies and invest only in the high quality companies that are run by high quality management. So you can, it's very simple to find out where to invest. Just see the products that you're using and find out more about those companies that are say, producing those products and services. Now for me, what I do in my fundamental analysis is that I do it on a weekly basis and I do it on a daily basis. I have these news feeds coming from all over the place, and I take the news that is being fed to me and I take it as it comes. I don't judge it, I just take it. And once the news has come to me, then I try to relate it to the various products and services that I have, and then from there I make my judgment as to what I should do. So that is what fundamental analysis is. That is where you have the earnings per share. You are judging the company's earnings, the performance, the outlook for the company, etc. That's what it is, news. Then the next phase is technical analysis. Now technical analysis, it can be a little bit complicated, but what I do is I use a free service on stockcharts.com. What that does, let me share with you the chart that will give a better idea. I just uploaded this chart of Reliance, and for the sake of simplicity, I use two kind of indicators, three really. One is the moving averages, and I use 7 and 21 periods, and I use the stochastics. These two are, say for example, the moving averages here, the 7 is the blue one, the blue line, and 21 is the red line. So when I try to see how the market is doing, the first thing I do is I try to find the trend. And here the 7 line is above the red line, which means that the market is in an uptrend because the 7 is above the 21. At the same time, I look at the stochastics. The stochastic is more of an oscillator. Oscillator means if the market is overbought or oversold. So that takes a little bit of practice, but I think you will come to know once you start analyzing the markets over a period of time. So let me give an example. Like here, the 7-period line is crossing over the 21, and the stochastics are still below the overbought level, which is 80, and the oversold level, which is 20. So as long as it is below 80, you know that the market can be bought. So I would buy it where this thing is clearly, this 7 is above the 21. So I would probably buy it here, and I would just ride it up and see the stochastic. See also the volume is increasing. The volume indicator is showing that the volume is increasing as the market price increases. So that is an indication that this stock is in an upswing. So I would purchase that. Now this is something that people spend hours analyzing, and I would urge you to take a look at the way these technical analysis is done.
Ranga, we are not interested in this here.
Oh, I'm sorry.
Oh, yeah, maybe you can use the thing pointer to point out whatever you wish.
Okay, sorry.
That would be good.
Okay, so as I was saying, the 7 is crossing above the
If you
21.
could repeat whatever you said in the last 2 minutes, because we couldn't see it.
Okay, so say the 7 is above the 21,
Yeah.
and the oscillator is below the 80 level, which means the market is still in an upswing. So you will just ride it until this oscillator starts to fall down, which is somewhere here. So you would probably buy it here, and you would sell over here. So this is like maybe a week worth of trade, and you can just take a look. The second thing is that you have to see when the 7 period line is falling below the 21 period line. So that will tell you that the market is going to decline from there. And a classic example here is right here. Can you see? Right here. You see it's above 80, right? Above 80 here. And here the market is starting to show the red indicators, which means that it is starting to weaken. So from here, you would probably sell the market here. It just hung around here for a while, and then it started to decline. And then here, you will see that it's in a kind of period of consolidation, and you would maybe just buy here if you want to, but I think it's a very weak signal, so I don't even do anything, and then take it when it goes up here again, and take a sell here, and then the market really declines. So it's actually more of an art than a science. It takes practice to be able to analyze the markets in this way. So this is what I just want to share with you, these 2 kinds of analysis that exist in the market. Sorry.
No. But these charts are available online?
Yes, this is stockcharts.com, which is a free service basically.
The mini charts are available.
Stockcharts.com.
But
Okay.
Ron is not.
This is a good source for analysis.
Yes, very good source for analysis, yes. Let's talk about stock trading versus option trading. And that's really what this workshop is all about. I don't trade stocks per se. I trade options. And if you see the professionals, they don't trade stocks. Stocks are for birds. They trade options because of the various benefits that they offer. Let me give you an example. Say if you were to buy, the same example, like I said, buy 100 shares of Reliance at 1,000 rupees, right? So your outlay is 100,000 rupees or a lakh of rupees. Now instead of buying the option, if you were to buy the option on the Reliance share, which will probably cost you maybe 150 rupees instead of 1,000 rupees. So for 100 shares, your outlay is 15,000 rupees. So right there, your risk level has gone down.
Can you repeat this one?
The option that you buy, let's say you buy the option, instead of buying shares, you want to control the shares. So that option that you buy it for only 150 rupees. So your total cost outlay is 150 times 100, which is 15,000 rupees. So for 15,000 rupees, you're controlling the same number of shares that you would have bought for 1,000 rupees. So right there, your cost has come drastically down by investing or say trading in the stock options. Now let's say if the stock price would go from 1,000 to 1,100, your return is how much? Same 10%, right? But then the options, you bought the option for 150. It's very, say, if the stock price were to go from 1,000 to 1,100, the stock option can go from 150 to 250. I mean, this is just a kind of a generic example that I'm giving you, but it happens all the time. So if you were to buy the option at 150 and you were to sell it for 300, what's your return? 100%. So for only a fraction of the risk, you're able to make 100% versus risking the whole amount and making only 10%. That's the beauty of options. So I always trade options. I don't buy stocks because that's not my mental makeup. I like to be very risk averse. I want to know how much money I'm willing to risk without losing my sleep. So I like to do that to be able to sleep better at night and to be able to survive, to be able to trade and others. Like I said before, the trend, as we were talking about the 7 and the 21, so you have to first of all identify the trend of the market. That's the first thing that you would do. And like I said before, the 7 period line is above the 21 period line, that means the trend is up. So if you're able to establish the trend of the market, and say you think that the market is going up, you buy the call options. If you think the market is going down, you buy the put options. We will discuss these in more detail. I think if you just see your glossaries, there are the definitions in there. So I had urged you on the internet, on the blog, to study this glossary because this is exactly what I was talking about. That you have to know the terms before you can get the maximum benefit from this the workshop. And if you think the market is trending sideways, then you buy calls and puts in equal proportions. There are a number of strategies, but this is the general idea. Can someone read this for me?
Oh, yeah, I can.
Buy the call option.
Call or option is a financial instrument which gives the owner the right but not the obligation to buy an asset, the underlying at a specified price, the strike price by predetermining date, the expiry or maturity to a given party, and that is the seller of the put. The purchase of a call option is interpreted as a positive sentiment about the future value of the underlying stock. The term call comes from the fact that the owner has the right to call up to buy the stock or index.
Thank you. So do we understand this? Not yet.
Thoda.
So to understand this, what we're going to do, we will do an exercise, and I'm going to go over a graph that will help us to understand the options.
ये तो तेरे पढ़ने से so far ये ड्रेस हो गया अभी ड्रेस हुआ था बोलते
डॉक्टर चाहिए
Does everyone have the worksheet?
Oh yes.
Okay. So, anyone without the worksheet? Try to read it. There should be some more up. Okay, so what we're going to do, So here's an example. Say the stock of an XYZ company is trading at 50 rupees, just a hypothetical example. The call option contract with a strike price of 50 is expiring in a month's time and is priced at rupees 2. You believe that the stock price, the XYZ stock will rise sharply in the coming weeks, so you pay 200 rupees because to control 100 shares, you would buy them at 2 rupees and so you're buying 100 shares for 2 rupees, so your total cost outlay is only 200. And you buy a XYZ call option, right? Now, what I would like to do is to take a look at the graphs that I've sent out and to try to see the glossary and how the price it can be like as you see here in the graph. I want you to first do it yourself. Then I will come in and I'll try to explain. So you should have the glossary and you have the chart. So try to take a look at the two and we can just go back and take a look at the
What do we need to do, John? What do we need to do? What do we need to do now?
you need to solve this problem by looking at the glossary and the graph that I've given. So try to do it, and then we'll just go over it together. It's not it's very simple, but I just want you to be first able to do it on your own, so that you have a feel for it, and then know what the answer is. Oh, I'm sorry.
Ron, can you explain us?
What's that?
Can you explain us?
Explain what? No, that's what I want you to do now, because I had given you the glossary 3 days back.
Break even is not in this. Break even is not in this.
No, you don't have to worry about the break even.
So what exactly we need to do? Because the statement given there.
So what you do is you see the graph,
Yeah.
and on the graph it says that what's the strike price? So you're supposed to put the strike price there. What's your debit? So what's the strike price plus debit? And what's your break even, which is what the price at which you'll be breaking even. So just give it a try. It's a little difficult, I know, but you will get a hang of it. After you know the answer, you know what we're talking about. But just give it a try. You just spend the next 3-4 minutes try to do it. Just fill in the blanks. Just fill in these.
समझ में नहीं आएगा बस.
On the graph. Put the strike price plus debit. Put the strike price.
Jasneer, it's cola time.
तरीका बताऊं रॉन को पैसे दे दो रॉन को बोलो तुम
No talking. Hey, listen. This is serious stuff. If you guys want to make it 10%, work on it. Come on.
So 20 zero round को दे दो.
Done?
तूने बड़ा काम किया.
Making 10% is simple but not easy. You have to know, it's really a step-by-step method. All you have to do is to do the steps, you can make the money. It's your choice. But this is a very simple example that I'm giving of a very simple situation which can be implemented by anyone on any day. And I'll show you my results. These are the results I've been getting. I will show those results to you in just a short while. Okay, so let's move quickly because we have got 2 more worksheets to do. Okay, are you guys done?
Yeah, done.
Okay. So let's see. Anyone wants to give me? Oops, sorry. So what's the strike price?
50.
50. What's strike price plus debit?
52.
52.
Everyone got how it is 52?
Okay,
Because that's what you paid for the option, right?
What to?
Right? So 52. So what's your break even?
52.
52. Everyone got that?
Yeah.
52. Okay? Now what that really means is that a stock option with a strike price means this 50 because you're buying it at the money. At the money means that the strike price is the same as the price of the stock itself. At the money. At the money means, at the money. So the stock has to rise above 52, which is the break even for you to make money. So you will take this when you know or you think that the market is going higher. And you can only make money when the price is going above 52. Everyone got the call option thing?
Though I paid only 2 rupees for it.
Huh?
Though I bought it at 2
So you only bought for 2 rupees.
But right now the market is 50. That's
The stock price, that's the
all
stock
your
price.
rupees.
The stock price is 52.
Yeah.
Now that 2 rupee will become 4 rupees. What's your return? So instead of spending 50 rupees, you only spend 2 rupees.
But if it is just 51.90, I lose my entire money.
Yeah.
So,
Yeah.
10 पैसे में I'm losing my entire money and 10 पैसे में I'm starting making money.
No, sir. No.
No, I have a question here. There are many calls which are available.
Right.
Say for 50 rupees call.
We will not get into that right now.
That is
That's
the
a
key, that next step.
That's a whole different story.
Don't jump,
That's a
don't
whole
jump.
different story. Let's-
Don't jump.
Okay.
You need to press.
We will only stay with the basics right now, but we can take it offline. Okay, that is something that we can take offline. But for now, for the sake of the class and for the convenience of everyone, are we on the ball? Okay. Okay. So let's move on. Put option for a down market. Do you want to read that, Nijay? No?
A put option is a financial instrument which gives the owner the right but not the obligation to sell an asset, the underlying, at a specified price, the strike price, by a predetermined date, the expiry or maturity, to a given party, the seller of the put. The purchase of a put option is interpreted as a negative sentiment about the future value of the underlying stock. The term put comes from the fact that the owner has the right to put up for sale the stock or index.
Thank you, Justine. Now, the same concept when you were thinking of, when you thought the market was going up or the stock was going up, now we are taking a scenario where the stock is going down. So that's where you would buy a put. Now, for this thing, I have this example, and I'm going to pass out some worksheets, which are just the opposite of what happened before. Could you please pass this out? Let's do this quickly because we're running out of time and I don't want you to be shortchanged about this knowledge that I'm not here. We done it?
Market US कर गया release कर दिया
The option of Okay, let's take 5 minutes. Now everyone, if you can, okay, now let's please silence, please. We have a limited time. It's only 30 minutes. We have got one more exercise to walk through. Okay. Okay, this
One more
exercise is, suppose the stock of XYZ company is trading at 50, a put option contract with a strike price of 50 expiring in a month's time is also priced at 2. The same example, but I just put it in reverse. You believe that the XYZ stock will fall sharply in the coming weeks, so you pay 200 rupees for the same thing. Now what we're going to do is, we are going to use the graph that I just passed out, and we are going to just write the numbers as we did in the earlier. So that we have an idea as to what this thing really means, how the definitions are working here. That's the only thing we're doing here right now, at a very basic level. Okay? So let's take the next 2-3 minutes and do this.
That's done. Yeah, done.
All of you done?
Yeah.
All of you?
No, I am not done.
Yes.
They can save the time.
This takes time, okay? So if you're not understood right now, that's okay. It takes time. This is not, this is your broker won't even know about. I can guarantee you go talk to your broker, he will just draw complete blank. He would know what you're talking about. He said, oh yeah, मैंने सुना है options के बारे में बहुत खतरनाक होती हैं. वो इसलिए खतरनाक है कुछ पता नहीं. Okay? So can I move on?
Yeah.
But do anyone tell it for the people?
Anyone?
We will.
Ron does it for you. Ron does it.
तो जमा कर देते हैं।
Okay, so this graph you have, right? Hold on. So this graph you have. Now, the same thing what we did before, but here what we're saying is, now what's the strike price?
50.
50. Now, when you're buying puts, you have to subtract the debit. 48. 48. So the market has to go below 48 for you to make money. Because the market sentiment, as per your analysis, is going down now. So the market has to go down for you to go below the break even of 48 for you to make money. Is it clear?
Yes.
It's clear.
Yeah.
Any questions?
No, we don't have any questions.
Okay, fine. Okay, so this is for the market going down. Now, the first worksheet that we did was for the market going up. Now we will deal with a situation where we don't know where the market is going. So I said to you before that we are going to study what are the different market scenarios. The one is market going up, one is going down, and the third one is called the straddle in a sideways market. Now this strategy has worked out for me extremely well. A recent example of when the union budget was to be announced, there was a big turmoil in the market. Everyone was thinking market is going up, but the market really went down. My algorithm told me in the morning is going to be a big crash. And against all those, the advice of the CNBC pundits, which I don't see anyway, but sometimes I have to see because when I turn on my computer, just flash up. They were saying the market is going to take a real climb today, but I didn't listen to that. So, a long straddle, someone wants to read it?
Yes. Long straddle, sideways market. Long straddle is a combination of buying a call and buying a put, both with the same strike, price and expiration. Today they produce a position that should profit if the stock makes a big move, either up or down.
क्रैश हो गया मार्केट क्रैश
Now, this is the most
Total call दोनों खरीदो।
profitable strategy that I have come across, and it has made a good amount of money for a lot of people. So what I would like to do is, I'd like to graph of these, spread these graphs. If you could kindly help me for the sake of time here.
Yeah, they will do it. I have done my job.
करना चाहिए ऐसे कैसे पैसे बचा
Okay, so while this is being passed out, let me share with you an exercise that we're going to do. The call was the market going up, the put is the market going down, right? Now this is where we don't know. We are in a no man's land. And this is the best scenario because when there is confusion in the market, that's the time you make money. And this is exactly what the strategy does for you. So let me just go over it. Suppose the stock of XYZ company is trading at 50. You buy a call option with a strike price at 50 at the money, the same as the price of the stock, expiring in a month's time. It's being priced at 2 rupees. At the same time, you buy a put option with the same strike price, 50, expiring in a month's time at 3 rupees. Each of the call and the put options are covering 100 shares. So what you're doing here is you're taking a delta neutral position. Let me not use that term. It means that you don't know where the market is going, right? So when you have that kind of scenario, you want to buy both sides. So here you are spending 2 rupees for the call and 3 rupees for the put. So what's your total cost per option? Or say per trade? 5 rupees, right? Okay, so now with that information, I would like you to fill in the blanks for this. And we'll go over it.
Ron, before that, the other slide.
I'm sorry.
previous slide.
Previous? Sorry. I should have kept it. Any questions? Everything okay?
No.
What is the last five? I think.
Done? Okay. Okay, let's take a few minutes. What's that? ATM is at the money strike. That's why I said 15. Because we only using at the money options. We're not getting into the out of money and stuff. That we'll discuss offline. You don't have the time right now, but I can stress it.
How many minutes to go?
3 minutes.
Around 3 minutes to go.
Average.
3 minutes to go.
You can extend now, you can extend from 5 minutes.
No, we can't.
Okay, so can we move forward?
Yeah.
All right. So what is the at the money strike?
50.
50. Now this is in a neutral position. So what does so we had bought this at 50, right? And we paid 3 rupees for the put and 2 rupees for the call. So we paid 5 rupees. So how much it has to decrease or increase by? 5 rupees. 5. So 50 plus 5 is 55. 50. 50 minus 5 is 45. So the break even will be 45 or 55. It has to move beyond these two prices for the trader to make money. Right? Now what happened was, on the day when the budget was announced, the market took a real dive. That the 2 rupees that I had paid for the call expired at 0, and the puts went up to 200 in one day. This is what I'm talking about, the power of the put. Like suppose if you were to just buy stocks in the morning and the market went down, you would probably commit suicide by the evening. Because that kind of a loss would not be there. You don't want to be in that position. And a lot of people do that. I've seen people jumping out of the windows of Wall Street, like during the crash. It happens. But then if you know how to manage your risk, and this is what I keep telling all the time, manage your risk, you'll be fine. Okay, now, this is where,
Now you said 283, would it be 47 and 52?
no, it's
The total cost is 5, no?
5 is total cost. You have to take the total cost on both sides.
But till you cross
Now
either
this-
the boundaries, you lose your entire money. This you should tell everybody.
Tell
Like
what?
till you either cross 47 or 52, you are losing 100% of the money.
That will come in feedback. Okay, fine.
You should make this clear because people are not understanding this.
No, 50 and 55 or 45.
Till this range is crossed, you
Yes.
lose your entire money.
No, that's what I said, that,
Yeah, people are not understanding this.
well, no one said it to me, but anyway. So this is where the rubber meets the road. And I'd like to share with you my actual results that I have achieved. Over the okay, what I did here was I just so I have taken the last 8 weeks of data. In the month of April, I lost 89,000 rupees in 1 week. It should be somewhere up here. 89,000 that I had lost in 1 week. But I didn't let that deter me. In this 8-week period, I have made as much as 156,000 rupees in a week, 56,000, 29, 98,000, and all that. So just to take the 8-week total, and of course this past week was very difficult for me because of family situation and illness. But in spite of that, this 8-week period, I made 3.73 lakhs. Okay, the sampling that I've taken. And that works out an average, a weekly average of 46,685. And I always keep an allocated capital of 5 lakhs. That I average. If the market conditions are improving, I will increase it. If it's decreasing, so I have to just reposition, like rebalance my portfolio from time to time. So that works out to an ROI of 9.34% per week, and that's 37% per month. For the sample that I've taken the worst week, I've taken the middle, and the best weeks that I have. So when you combine all these three, this is my return for this 8-week sampling that I did. Any questions on that?
Was I on the basis of market analysis of yours or on the basis of mine? On what basis?
He has got his own
And all this information that I've shared with you up to now, that is the foundation of my asset work.
Which company?
7 days, 21 days.
40 मिनट में क्या सब 10%
Okay, let's move on. We have got very limited time. Okay, now I have got a friend here. I was traveling to Chandigarh, and that day in the morning I was having breakfast, and I took a trade, and then I went out. And that friend is Atul. So I want Atul to just share with you what he saw there.
So,
Can you stand up?
So actually it's his habit to trade in the morning, 3 hours in the morning, and that time he doesn't want anybody to disturb. So on that day he made around 32,000, 32075 is the exact income which he got.
And that was in only about 3 hours time.
3 hours.
3 hours time. So that's a testimonial. I of course thought that I'll just take an example from Dr. Rajan because he called live testimonial, so I got this. All right.
And this is for
Now this is the most important part. Okay.
वीजा का बिल दो रोन
Okay, yes, so now you have to sum it up. Last 2 minutes, let's pay attention
Okay,
and then you are
okay.
finishing this up.
Okay, this is the most important part. Money management. Risk what you cannot afford to lose. That's the bottom line. Never risk more than 2% of your portfolio in option trading. Don't bet the barn on one trade because you'll be out of the barn very soon. Don't do that. And also never risk more than 15% more than the allocated money of the option money, 15% of the 2%. Be risk averse, get rich slow. And the last one, the reward risk ratio should be 2 to 1. That's what I use. All these experiences that I am sharing with you are my own experiences. This is not a recommendation to anyone. This is just what I do for myself. And that's all I can share. But you can use that as a template.
What does it mean, previous life?
Later on. Now, just to summarize, the up market, at the money calls, down market, at the money puts, sideways markets, buying those markets. There's a saying, bulls make money, bears make money, pigs get slaughtered. So pick in the market. Now, what are the next steps that you should take? You should talk to your investment advisor, like I said before, because everyone's situation is different. This is not a get-quick-rich scheme, because it takes study and time. Work with an experienced professional who has been working on this for a while, and you should find a professional. I think there are professionals out there, to answer your question, who work on a profit-sharing basis. So you have to find them out, okay?
One is standing in front of us.
Now, one thing is what Warren Buffett says: don't try to get rich quick. Patience is the name of the game. So be patient; it'll happen. And that's my presentation.
Oh.